Welcome back to MonsterInvest. I'm Daniel. I want you to close your eyes for a second. Imagine a millionaire. What do you say? If you're like 99% of people, you probably see a flash of red, maybe a Ferrari speeding down a coastal highway. You see a penthouse view of the Manhattan skyline. You see a diamond watch that costs more than most people's college tuition. You hear noise. You see movement, you feel speed. We are conditioned by movies, by Instagram, and by music videos to believe that wealth is loud. We think that getting rich is an event, a singular explosion of luck, or a genius trade, or a viral moment that changes everything overnight. But today, I am here to tell you that this image is a lie. The kind of wealth that lasts, the kind of wealth that changes a family's destiny for generations, is not loud. It is deafeningly quiet. It is boring. It is so painfully slow that if you made a movie about it, the audience would walk out of the theater in 20 minutes. Today, we are going to spend some serious time deconstructing the three investments that quietly create millionaires. And when I say quietly, I mean it. These are not the investments you brag about at a dinner party. If you talk about these at a bar, people will probably turn away to talk to the guy buying crypto. But while the guy buying crypto is stressing over 20% swings in a single night, the people holding these three investments are sleeping like babies. And 20 years later, the crypto guy might be broke, while the quiet investor is retiring in total freedom. So buckle up, we are going deeper today than we ever have before. We are going to look at the math, the psychology, and the stories of three specific archetypes. Let's call them the compounding owner, the utility landlord, and the skill stacker. Let's begin with investment number one, the boring market mechanism, or as I like to call it, betting on the house. To understand this, I want to tell you a story of two people, Sarah and Dave. They both start working at the same company on the same day. They are both 25 years old. They earn the exact same salary, $50,000 a year. Now meet Dave. Dave is smart. He watches the financial news every morning. He subscribes to 3 different stock-picking newsletters. Dave wants to be rich and he wants it now. He believes he can outsmart the market. So he takes $500 a month and he trades. He buys a tech stock because he heard a rumor. It goes up 10%, he feels like a genius. He sells. Then he buys a biotech company. It crashes 50%. He panics. He sells. He spends hours every week analyzing charts, reading earnings reports, and stressing out. Dave is playing a zero-sum game. He is trying to find the needle in the haystack. Now meet Sarah. Sarah admits something that Dave's ego won't let him admit. She knows she cannot predict the future. She knows she is not smarter than the collective wisdom of millions of traders. So Sarah does something incredibly boring. She sets up an automatic transfer. The day after she gets paid, $500 leaves her account and buys a low-cost index fund, let's say the S&P 500 or a total world stock market index. Sarah buys the haystack. She doesn't own one company. She owns a tiny sliver of the entire economy. She owns a piece of every innovation, every iPhone sold, every search query made, every package delivered. Let's fast forward 5 years. Dave is exhausted. He has had some big wins, sure. He bragged about them at lunch. But he has also had some crushing losses that he kept quiet about. After taxes and trading fees, his portfolio is basically flat. He has stress but no real wealth. Sarah, she hasn't looked at her account in 5 years. She has been busy living her life. But that account has been growing at an average of 8 to 10%. It doesn't sound like much, but let's fast forward again. Let's go to age 55, 30 years later. Dave stopped trading years ago because he got burned too many times. He missed the best days in the market because he was trying to time the bottom. He has some savings, but he's worried about retirement. Sarah is now a millionaire, and I don't mean she has $1 million in net worth including her house. I mean she has over $1 million in liquid assets in her brokerage account. How? She didn't win the lottery. She didn't pick the next Amazon. She simply rode the wave of human productivity. This is the first quiet investment, the index fund. Why does this make millionaires? Because it removes the biggest risk to your wealth, you. It removes your emotions. It removes your ego. It removes the temptation to sell when things are scary and buy when things are expensive. The quiet millionaire understands that the stock market is not a casino. It is a vehicle for transferring wealth from the impatient to the patient. Sarah invested in global capitalism. As long as humans are solving problems and companies are making profits, Sarah gets paid. She doesn't need to be smart. She just needs to be consistent. So the lesson from Sarah is this: be the house, not the gambler. Own the market, don't play the market. Now let's shift gears to something tangible. Investment number 2, utility real estate. Notice I used a specific word there, utility. Most people misunderstand real estate. They think real estate investing means buying a beautiful vacation home or flipping a rundown house in 3 months like they see on TV shows. That is not investing. That is speculation, or it's a second job. I want to introduce you to Mark. Mark is a high school history teacher. He doesn't make a fortune, but Mark understands the law of need. Mark knows that no matter what happens to the economy, whether there is inflation, deflation, a recession, or a boom, people need a roof over their heads. When Mark was 28, his friends were buying starter homes. They were stretching their budgets to buy the nicest house the bank would approve. They bought liabilities, houses that took money out of their pockets every month in the form of a mortgage, insurance, and taxes. Mark bought a duplex. It was in a boring neighborhood. It was a beige box. It wasn't sexy. Mark lived in one side and rented out the other side. The tenant next door paid $1,000 a month. Mark's total mortgage was $1,500. So Mark was living for $500 a month. While his friends were paying $2,000 a month for their dream homes, Mark was saving $1,500 a month simply by having a lower housing cost. This is what we call house hacking, but that's just the start. Because Mark's living expenses were so low, he saved up another down payment in 3 years. He moved out of the duplex and into another small single-family home. He kept the duplex. Now both sides are rented. The duplex is no longer just covering his rent, it's producing positive cash flow. Let's say $500 a month in pure profit after expenses. Mark is now 31. He has an asset that pays him to own it. But here is the secret, the quiet part of real estate that millionaires love but rarely explain. It's not just about the cash flow. It's about the 4 wealth generators working simultaneously. 1. Cash flow, that's the extra money every month. 2. Appreciation. Over time, the property value goes up with inflation. 3. Tax benefits. The government loves real estate investors. Mark pays very little tax on that rental income because of something called depreciation. And 4, and this is the big one, amortization. This is the silent killer of poverty. Every single month, Mark's tenants send a check. Mark uses that check to pay the bank. A portion of that payment pays down the loan. Mark isn't paying his mortgage. His tenants are buying the house for him. Mark repeats this process. He doesn't go crazy. He buys one boring, functional rental property every 5 years. By the time Mark is 55, he owns 5 properties. Let's say they are worth $300,000 each. That's $1.5 million in real estate assets. And guess what? The mortgages are almost paid off. His tenants spent 25 years paying off Mark's debt. Mark retires with $1.5 million in assets and, let's say, $8,000 a month in passive rental income. He is not a genius. He didn't invent an app. He just provided utility, basic, clean, safe housing, and let time handle the debt. The quiet millionaire knows that you don't need to own the Empire State Building. You just need to own a few roofs that protect working families from the rain. And finally, we arrive at investment number 3. This is the most important one. This is the one that accelerates the first 2. If investment 1 is the engine, and investment 2 is the sail, then investment 3 is the fuel. Investment number 3 is high-yield human capital. Let's talk about Alina. Alina works in marketing. She's good, but she feels stuck. She's earning $60,000 a year. She looks at her budget. She has $3,000 in savings. Now conventional wisdom says, Alina, put that $3,000 in the stock market. If she gets a 10% return, she makes $300 in a year. That's okay, but $300 isn't going to change her life. Alina realizes something profound. At the early stages of wealth building, your capital is low, but your potential is high. The highest rate of return isn't in the S&P 500, it's in her own brain. So Alina takes that $3,000 and she does something risky. She spends it. She spends $1,000 on a comprehensive course on data analytics. She spends $1,000 hiring a career coach to help her with leadership skills. She spends $500 on books about consumer psychology. And she uses the last $500 to attend a networking conference in her industry. Her bank account goes to zero. Her friends think she's crazy. You wasted your savings, they say. But 6 months later, Alina is a different person. She brings a new proposal to her boss using the data skills she learned. She negotiates with the confidence she learned from her coach. She doesn't just ask for a raise, she demonstrates value that makes her indispensable. She gets a promotion to senior strategist. Her salary jumps from $60,000 to $90,000. That is a $30,000 increase in income every single year forever. What was the cost? $3,000. That is a 1,000% return on investment in the first year alone. There is no stock, no crypto, no real estate deal on earth that yields 1000% safely. But Alina doesn't stop. She keeps reinvesting 5 to 10% of her income back into her skills. She learns public speaking. She learns how to manage teams. 10 years later, Alina is a VP, earning $250,000 a year. Now look at the difference. If she had just saved that initial $3,000, it might be worth $6,000 today. But because she invested in herself, her earning power increased by nearly $200,000 per year. And here is the magic. Alina uses this massive income to fund investment number 1 and investment number 2. She maxes out her index funds. She buys the rental properties. She is pouring fuel on the fire. The quiet millionaire understands that the ultimate asset is their ability to solve problems. Inflation can eat your savings. The market can crash. Real estate can burn down, but no one can take away your skills. If you dropped Alina in a random city with no money, she would be wealthy again in 5 years because she has the software installed in her mind to generate value. So we have the 3 pillars. First, we have the index fund, creating wealth through ownership of the global economy. Second is utility real estate, building wealth through debt amortization and time. And third is human capital, which creates wealth by increasing your value to the marketplace. But if the formula is this simple, why isn't everyone a millionaire? Why do we still see so many people struggling financially? It brings us to the final piece of the puzzle, the trap. The trap is not economic, it is psychological. It's called lifestyle creep and the ego. Remember Dave, the guy who tried to day trade. Let's say Dave actually gets a raise. What does Dave do? He buys a BMW. He upgrades to a luxury apartment. He starts eating at $100 steakhouses. He looks rich, he signals wealth. But every dollar he spends on looking rich is a dollar that is not working for him in the quiet investments. The quiet millionaire practices what I call strategic invisibility. When Sarah became a millionaire, she was driving a 5-year-old Toyota. When Mark paid off his 3rd rental property, he was still wearing jeans he bought at Costco. They weren't suffering, they were just refusing to play the status game. They realized that freedom is more valuable than looking impressive to strangers. So what is the action plan for you? How do you take this 20 minutes of listening and turn it into a reality? Step 1, audit your human capital. Are you stagnating? What is one skill, just one, that if you mastered it would double your income in the next 3 years? Is it sales, coding, management, public speaking? Identify it and spend the money to learn it. Buy the course, hire the coach, stop looking for free YouTube videos and invest in structured learning. Step 2, automate the boring. Don't trust your discipline. You are human, you will fail. Set up an automatic transfer for investment number 1, even if it's just $50 a month right now. Get the system running, treat it like a tax. It's gone, you never see it. Step 3, look for utility. If you are ready for real estate, stop looking at HGTV. Stop looking for dream homes. Look for numbers, look for cash flow. Look for ugly houses in decent neighborhoods that you can improve. And finally, step 4, embrace the silence. Stop looking for the big break. Stop looking for the lottery ticket. Fall in love with the boredom. Fall in love with the slow, steady, quiet progress of your net worth ticking up, month after month, year after year. Let me leave you with this final thought. A tree does not grow with a bang. You cannot see a tree growing if you stare at it. It grows in total silence. But give it 20 years and its roots will crack the concrete. Its branches will cover the house. It becomes an unstoppable force of nature. Your wealth should be like that tree. Don't be the firework that explodes once and fades away. Be the tree. Quiet, steady, unstoppable. I hope you found immense value in this deep dive today. We covered a lot of ground, but if you take nothing else away from this episode, remember these 3 core principles. First, do not trade, own the market. Second, do not buy luxury, buy utility. And third, do not hoard cash, invest in your skills. If this episode shifted your perspective, please do me a huge favor. Hit that like button. It really helps the algorithm show this to more people who need to hear it. Make sure you hit subscribe and turn on notifications so you don't miss our next deep dive. And finally, share this with just one friend, just one person who needs to hear that it's okay to be boring and it's okay to get rich slowly. I'm Daniel, this is MonsterInvest. Thank you so much for lending me your ears today. Now go out there and build something that lasts. I'll see you in the next episode.